I am today with Siddharth Srivastava, Head ETF Products and Fund Manager at Mirae Asset Mutual Fund. On the eve of the launch of India's first hybrid ETF, which is the one that Mirae is now coming out with, it's a combination of the 8 to 13 year G-Sec and the Nifty Momentum 30 index.
Why not within this hybrid? Let's go aggressive on the equity side. Anyways, my drawdown is getting protected by the G-Sec.
You're combining a steroid with morphine. Like on the one hand, momentum is going to race ahead. On the other hand, debt, of course, will provide stability. So you said, of course, that that's the reason why, because people get afraid of the volatility.
Yes, there's a duration risk which comes with 10 year and it can have its own volatility.
But I think the main advantage of the dawn of hybrid ETFs is that you get long-term capital gain 12.5% after 1 year.
Yeah.
Which is tremendous. Welcome to the Thefynprint. I am today with Siddharth Srivastava, Head ETF Products and Fund Manager at Mirae Asset Mutual Fund. On the eve of the launch of India's first hybrid ETF, which is the one that Mirae is now coming out with, it's a combination of the 8 to 13 year G-Sec and the Nifty Momentum 30 index. So, Siddharth, what prompted this? Tell us more about this.
Yeah, so very recently, in fact not recently, around a year or two back, SEBI allowed passive hybrid funds to be launched, and that came under MF Lite circular, if you remember. So now AMCs can launch debt oriented or equity oriented or balanced passive hybrid funds.
Sure.
Each AMC can launch one ETF or one index fund in each category. Okay, so recently two debt indices were allowed to become part of this hybrid product, which is 8 to 13 year G-Sec,
Yes.
and 3 to 6 month financial services product. So the opportunity arose that now we can create the hybrid product. And
Right.
we
So
took the
just to
opportunity.
explain these two indices to our viewers, so 8 to 13 year G-Secs is government bonds of long maturity, relatively long maturity, 8 to 13 years. And the 3 to 6 month financial services is debt issued by banks.
Yes,
Primary.
CP, CDs issued by your banks, NBFCs, etc. So that product is allowed. The logic behind that is that SEBI has said that you can use only given set of equity indices, and these equity indices should have either passive products based on them or should be a primary benchmark, and AUM on them should be at least 5,000 crores. And for the debt portion, SEBI said that these need to be constant duration. So target maturity products are not allowed. Constant duration. And then again, AUM needs to be a minimum of 5,000 crores. So now this year, these two debt indices became eligible because of crossing this AUM threshold.
Yeah.
And creating a hybrid product became possible. And then we looked at the opportunities and we really found momentum plus 8 to 13 year G-Sec a very powerful as well as differential combination. Because what we realized is we have seen smart beta investing and factor investing becoming very popular. But also people are very scared of the drawdown which comes with momentum investing.
Yeah.
So we said, why not within the hybrid category mix equity, which is based on aggressive strategy like momentum, okay, which is fairly popular. It is the most popular smart beta strategy, and then mix it with 8 to 13 year G-Sec, so that through the equity portion, you are able to target the market upside in a more aggressive manner, but then you are able to protect some of the drawdown using the G-Sec component, and thus avoid some of the drawdown which comes with the momentum strategy.
Yeah. So I'll come to that in a bit, but I think the main advantage of the dawn of hybrid ETFs is that you get long-term capital gains 12.5% after 1 year.
Yeah.
Which is tremendous. Like in debt, if you hold a normal debt fund, you will always be short-term. You'll always be taxed at your slab rate.
So basically, because we have done the balanced one, where the G-Sec is around 50%, so there are products which are active mutual fund products which take similar exposure. So there also LTCG is for 12.5 years, but it is applicable after 2 years.
Exactly.
But since ETF is listed, that becomes 1 year in this case, and which becomes a somewhat equivalent to what equity like
Yeah,
taxation is for equity
yeah,
oriented mutual fund. So becomes a comparatively compelling option.
yeah. I mean, this is a lot of people are quite hung up on the 1 year versus 2 years time horizon, and this solves for this, I think, for the first time. And potentially, if more and more indices are allowed by SEBI, then you could have a lot more products into this category. But let's zoom into product that you've constructed here, because momentum is seen, as you rightly said, like high risk, high return. It's, in my mind, you're combining a steroid with morphine. Like, on the one hand, momentum is going to race ahead. On the other hand, debt, of course, will provide stability. So you said, of course, that that's the reason why, because people get afraid of the
See,
volatility.
ultimately, you have to think of, when you think of new product, you have to think what solution does this product provide, right? There are enough number of hybrid funds which are there in the market, which are typically, if you look at hybrids, nobody is going ahead and taking a strong momentum call,
Hmm.
right? Uh, it's pseudo, in a way, targeting more stability
Hmm.
within the equity also. So what we thought was, why not within this hybrid, let's go aggressive on the equity side. Anyways, my drawdown is
Hmm.
getting protected by the G-Sec.
Hmm.
Yes, this product will have more volatility
Hmm.
compared to, let's say, a typical hybrid fund, because we are using momentum, and
Yes.
also on the G-Sec side, it's a high duration product.
Hmm.
So volatility will be there, but the upside capture will be much better. And when we are looking at a long term data,
Hmm.
7 year data or a 5 year data, the results are great, because if you are able to navigate some of the volatility, then these two combinations are pretty powerful.
Okay. So I was looking at the returns for the momentum, the Nifty 200 Momentum 30 index, and the 5-year returns are between 12 and 13%
Yeah,
CAGR. For on the debt side, the 8 to 13-year index has returns of 6 to 7%.
yeah,
So, in your back tests, what has the combined product shown in terms of past
yeah.
back tested returns?
So I'll uh, try to answer this in a very simple manner. So as you go longer, this combination of 50-50 momentum plus G-Sec
Hmm.
is giving you returns similar to what your benchmark Nifty 50 indices is giving,
Hmm.
around that ballpark. So if we are looking at a 7 year data and we are looking at Nifty around 12% or
Hmm.
so, this will give you 50-50
Hmm.
combinations giving you around 12% return.
Hmm.
So it won't be giving you, let's say, equivalent to what mid cap is giving, or
Sure.
in a long term, or
Sure.
what, let's say, multi cap product will give.
Sure.
But even with a 50-50 combination, if in the long run I'm able to get somewhere around return of what benchmark indices
Hmm.
are giving, I think I think the results are pretty good, because when you're looking at volatility, uh, 7 year volatility of Nifty 50 is, let's say, around 16,
Hmm.
17. For this product of a 50-50 combination is around 10.
Hmm.
And if you look at G-Sec, that's around, I think, 6 or so.
Yeah.
So your volatility is significantly reduced. And when we are looking at rolling return
Hmm.
data also,
Hmm.
especially for I think 5 year or so,
Hmm.
3 year, 5 year, you will see that instances of negative return
Hmm.
for equity product is there.
Yeah.
For Nifty 50, it can have, or a 5 year negative return. That instances of negative return is completely done away with when you are having a
Okay.
hybrid product.
Hmm.
It's a backtested data, so
Of
things can
course.
play out obviously differently
Hmm.
going ahead. But backtested data is of two live indices, so
Hmm.
it's not something which, where everything is in a way tweaked to make it look beautiful.
Correct.
But hence, from a return point of view, what I'll say is that if you're looking at a hybrid product, you're okay with uh, Nifty 50 like returns with a much reduced volatility, this is a product for you.
Now, within the ETF, you will have to do a fair bit of rebalancing, right? Because momentum index will get refreshed quite a bit.
Correct.
How much does that add to cost?
It does. It's a great question. So there will be two costs. One is momentum index gets churned every 6 months, and that churn is at times pretty violent.
Yeah.
So, for example, in a 30 or stock index, you can get a churn of, let's say, on an average, 7 to 10 stocks. I won't be
Mm.
surprised if I'm
Mm.
getting that
Mm.
average. In fact, the recent change was even more than that
Mm.
for momentum index. And also, additionally, every month, the weightage will be brought back to 50-50.
Mm.
So for example, if on a mark-to-mark basis within a month, weightage of equity shifts to
Mm.
52, it will be brought down to 50. So that will incur cost. Cost is obviously dependent on upon the turnover.
Mm.
But what I'll say is that since momentum, in a way, gives you or seeks to give you that higher return, and if it succeeds in doing that, which it has in the long run, then that cost is not very significant. But if you look at tracking difference and
Mm.
everything, then for example, a Nifty 50 ETF will underperform Nifty 50 index by, let's say, 5 basis point or
Not
so.
much.
Yeah, but in case of momentum, that can go as high as, let's say, 40, 50 basis point, because
Mm.
even the cost of underlying ETF is around 30 basis point. In our case, I expect tracking difference, because it's a 50-50 product. I expect tracking difference to be in the range of around, let's say, 15 basis point to
Mm.
20 basis point. That should be tracking difference range,
Counting the expense ratio, not counting it.
not counting the expense ratio.
How much is the expense ratio?
Expense ratio of the ETF will be around 25 basis point.
Okay.
So I
So.
expect around 40 basis point, 50 basis point of
Mm.
tracking difference. Having said that, this is assumption, so people should obviously check out when the product actually starts performing.
Yeah. Yeah. So let's look at a couple of scenarios, right? So momentum outperforms when there is a raging bull market.
Correct.
We are not in one now,
Correct.
but you never know when one could start. So that's a great scenario for this index. Long-term debt outperforms when there are rate cuts. Aren't these two kind of, don't they sort of go together? Because when there is typically a bull market, it could be started by a series of rate cuts.
Yeah.
Uh, so can you just paint some scenarios
Yeah.
for
So
us?
so first of all, momentum performs in two phases. One is what you mentioned, when there's a bull market, when everything is performing, and second is when there is an observable trend.
Okay.
So, for example, if I look at the market right now, all your capital intensive sectors are doing well.
Hmm.
Your defense, manufacturing,
Hmm.
even
Hmm.
etc. are doing well. Energy is doing okayish.
Yeah.
So momentum can latch on to this
Sure.
segment
Sure.
because it identifies whatever is doing well. And
Correct.
if you look at last 6 month, 12-month data, you'll see that momentum has outperformed the broad market, even when broad market Nifty 50
I see.
has struggled,
Hmm.
because rest of the market is showing some trend.
Hmm.
So that is there, and you are right about G-Secs. See, what we have observed is that if you look at the long-term data,
Hmm.
frankly, short-term, a 3-year G-Sec
Hmm.
and a 10-year G-Sec, there's no material difference between the performance.
Hmm.
If you look at a long-term data, right? Yes, there's a duration risk which comes with 10-year, and it can
Hmm.
have its own volatility. So what this product does is, Neil, that effectively, even if G-Sec is not performing better,
Hmm.
right, and let's say it's having a minor drawdown,
Hmm.
minor correction, it can give negative returns
Hmm.
because of duration, etc. in the short
Hmm.
term, right?
Hmm.
But what it will not do is not have a 25% drawdown of what
Hmm.
momentum is having.
Hmm.
So let's say even if G-Sec return is, let's say, zero,
Hmm.
okay, the 50% return, and my momentum has fallen down by, let's say, 20-25%, the average drawdown here becomes
12.
10, 12, 12
Yeah.
and a half, right?
Hmm.
So that itself is generating relative alpha.
Hmm.
So and when the things go right, when duration is my favor, then
Hmm.
obviously G-Sec will do
Rally.
well, and that
Yeah.
will add on to return. So what we realize is that in the long term it
Hmm.
doesn't matter. In the short term, obviously, duration will also play some part in how much buffer the it is
Hmm.
providing. But ultimately, since G-Sec doesn't fall that much, the high duration ones
Yeah.
also,
Yeah.
at least the things will be not as bad as momentum,
Yeah,
and
yeah.
the drawdown will be much less than
And
what a pure play will be.
and as your backtests show, that should be 10%, right? Sorry.
Yeah, the volatility will be
Yeah,
around
yeah,
10% or so.
yeah.
Even the back people can look at the presentation, and if you look at a 5-year data, at least the backtest show that for 5-year rolling, if I'm checking, there's no negative
Number.
returns on the 5-year rolling data. I think that is something which convinced us to launch this particular product, because we were also thinking that does 8 to 13 make sense or not, but when we look at the performance, it was okay.
Okay. So just to conclude, where should this sit? Like, who should be investing in this product? Um, is it the conservative investor who wants a smooth ride? Is it someone who's, has a high risk appetite, really wants to capture momentum?
Yeah.
Who is this meant for?
So we are essentially launching two products. So we are talking about ETF, but we are also launching an index fund.
Mm.
The difference is ETF is a 50-50 combination,
Mm.
and that is suited for a more risk averse investor. The idea should be that if I'm happy with Nifty 50 like return, or let's say
Mm.
Nifty
Mm.
100 like return,
Mm.
with volatility which is much less,
Mm.
with negative instances which is much less, if you
Mm.
are invested for a 5-year or so, then you should pick out the ETF 50-50
Mm.
combination ETF. Like I said, that 12.5%
Mm.
tax for
Mm.
greater than 1 year. On the other hand, if you are willing to take more risk,
Mm.
right, but you are scared of momentum volatility,
Mm.
then 75-25 combination of index fund is better. There it's an equity oriented
Mm.
mutual fund
Mm.
from a tax point of view. What momentum does in the long run, it delivers around 4% of alpha. That's what backtest shows. The 75-25 will target around 2% alpha,
Mm.
because you are having 25% of
Mm.
G-Sec.
Mm.
So it's good for people who are looking for a 2%. They're happy with 2%, 3%
Mm. Mm.
outperformance with a volatility which is in the long run is similar to what market volatility
Mm.
is.
Mm.
So in 50-50, your volatility is significantly reduced,
Mm.
even below Nifty 50 significantly, but with returns which is similar to Nifty 50. In
Mm.
75-25 combination, you have a possibility of that 2% alpha,
Mm.
but volatility remains like a market volatility. The momentum volatility is reduced,
Mm.
but it remain equivalent to what equity market volatility is. So it depends on your risk appetite and what you're seeking. So risk averse 50-50 is better. If you are okay with equity market
Mm. Mm.
volatility, okay with 2%, 3% alpha, then 75-25 is better.
They should go for the index fund.
Then you should go for the index fund. Yeah.
Okay. One last thing. So when people buy ETFs, often they don't realize that there could be a difference between the NAV and the market price. This is especially so with overseas ETFs.
Yeah.
Here, are there lots of chances of that happening, and what do people do?
Yeah, so what we are trying to do, and that will be delivered as soon as it gets listed, hopefully, is that we have tied up with, obviously, tying up with NSC to again provide the hybrid ETF NAV almost on a real time basis.
Mm.
So while SEBI mandates that you need to have NAV only 4 times during a day,
Mm-hmm.
so obviously at least 4 times during a day, we will be implementing the iNAV functionality. It may not be there from the go live,
Mm.
but very soon that you are able to view the iNAV almost on a real time basis. So people should be aware, and
And they can check this on the NSE website or on your website.
so both. So on our website, definitely it will be
Mm.
there, and on the NSE website also they can view it. So that is there for all the ETFs. And like I said, that always check iNAV before investing and use the limit order
Mm.
while putting the order.
Absolutely. Thank you so much, Siddharth.
Yeah, thank you so much, Neil.